Hi, this is Kelly Wright at the Money Show in Philadelphia, and joining me today, Marvin Appel, the signaler.com. I was reading one of your latest missives, and you had some interesting comments about the high yield market, which I think is probably 180 degrees out of phase of what we're hearing and reading most of the time. So I wanted to give you an opportunity to talk about that.
Well, thank you very much. Yeah, it's an interesting time in the bond market because the yield curve on the Treasury markets, 3 months, especially 3 month, 10 years, is inverted. And every time that's happened in the last 40 years, a recession has followed, sometimes with a delay of 2 years, but it's been a reliable recession indicator.
Indeed.
But what's interesting is that the high yield market is not confirming that pessimism. In fact,
so there's a divergence.
There is a divergence between the markets, and the saying I like to refer to is that money is often wrong but never insincere. So
that's good. I'm gonna plagiarize that anyway.
Well, yeah, it's not original to me. I plagiarized it myself.
Okay.
And so the fact is that high yield bonds are basically at or very close to total return highs. So they're not confirming the recessionary signal from the Treasury market. That's not to say they won't. I mean, we could get a recession in 2 years, but looking at the high yield market, and I view that as the canary in the coal mine, until we start seeing a downtrend, which is not at all in evidence yet, I wouldn't worry about recession, and I wouldn't bet that way.
Okay, so the reason for the inversion is not because of some of the traditional reasons why yield curves invert. I mean, the Fed is not raising; they're dovish. You don't see inventory starting to pile up, so some of those fundamental things. So the fact that the high yield market is not confirming, I would think would be a kind of a bullish sign on continued economic development. Is that?
Absolutely. I agree with that interpretation completely. I think that the economy is likely to continue its linear growth that's been in effect for a good 90 years now, and that's what the high yield market is telling us.
So Mr. Market rarely lies, he doesn't give you many opportunities, but so that's good. So now, also reading your missive, you were talking about a balanced portfolio. So do you still like the S&P 500 for stocks?
I do, maybe with an overweight towards consumer staples, but so if I were, the listeners, my recommended portfolio would be S&P 500 is really the core of it, the bulk of it. If you're going to overweight a sector in this environment, I like consumer staples. Now, no one could argue about that. The contrary argument is that consumer staples are at pretty rich valuations already. But my feeling is, if it's a bull market, you're going to most of your equity exposure should be S&P 500, and you'll do fine that way. If maybe you have an extra few percent weighting in consumer staples, so your S&P 500 with a double weight in consumer staples, let's say. If the market falls down, gets negative, the defensive sector should hold up relatively well.
I was always taught that staples were stuff that people need.
Exactly.
It's not a want issue, it's a need issue.
That's basically it, which is why they have held up relatively well in recessions. That people are not going to be cutting their purchases of toilet paper and food and such. If there's a recession, they're going to be cutting things that are easier to dispense with.
Why don't you tell folks where can they find your work and how can they subscribe to what you make available to them?
Oh, thank you. My money management website is signalert.com. That's signalert.com. And I also write an investment newsletter called Systems and Forecasts. And you can find out more about that on systemsandforecasts.com, including signing up for a free trial.
All right, excellent. Thank you so much for joining me today.
Well, thank you.
This is Kelly Wright at the Money Show in Philadelphia with Marvin Appel.